This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Vincent back on the show. Now let's get to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at MacroVoices.com. Just go to the homepage, MacroVoices.com, and click on the red button over Vince's picture saying, looking for the downloads. Okay, Eric, let's get your thoughts on equities.
Well, Patrick, E-mini S&P futures closed Wednesday right on the hairy edge of 6,000. I don't really have a directional view here. I think this is a headline-driven market. I could see it going either way. Patrick, what's your take?
Well, Eric, the market continues its slow grind higher, and we're now about 150 S&P points away from testing the all-time highs made between December to February earlier this year. Now, will the market test that? Well, it is the path of least resistance for this market to crawl higher, but we do have one important thing happening tomorrow, which is we're going to get the jobs numbers. And if there was any one thing that would derail this rally, could be an economic news miss on an important thing like a jobs number. So if we can get past that jobs number without the market turning, well, next week we have some inflation numbers and other things, but overall, the path of least resistance would be the market to maintain its existing trend a little bit longer and work its way higher. With that said, I do believe that their asymmetry of being long this market is diminishing, which is you're looking for capturing a few more percent on the upside as this market grinds at the risk that inevitably a mean reverting correction kicks in. Now, if we can get past that jobs number, maybe the market stays stable for weeks, if not a month. But I do believe that there is going to be some sort of a natural mean reverting correction. You don't have 1,000 S&P point move in just over a month without it giving part of that back in a typical retracement, especially as you approach a major previous high, which is now a resistance level. Point being is that if for new money being put in the market, it's probably best to wait for some sort of a market correction to be dip buying. And right now, it's just a matter of seeing where and how far this market can finish these moves before we see something that causes it to begin some sort of a correction. Maybe the correction could be driven by July earnings. It could be driven by the July jobs numbers. It's probably likely something going into the summer versus that something here in June. Well, Eric, what are your thoughts here on the dollar?
Well, Patrick, as we anticipated last week here on MacroVoices, the downtrend in the Dixie is back on in force. I expect further weakness. I think this is a secular trend that's set to continue.
Well, expecting further weakness is definitely the path of least resistance, Eric, but we are approaching a major support line, and the dollar is quite severely oversold. There is a measured move for the dollar index all the way down to the 95 level, and if the previous low doesn't hold as support, then it's not impossible for the dollar to still have another 2-3 Dixie points to the downside, but if the support level holds, it's far more likely that the dollar enters a prolonged period of a sideways grind. I'm not opposed to a U.S. dollar bear decline later this year that can even drop another 5 to 10 points, but is it all happen here in the first half of the year? And this is where I just feel that on the short term, this incredibly oversold state, if the support holds, we can have a move back to 102, 103 very easily, and it just grinds in a sideways trade range for a chunk deep into the summer, and then setting up for a big net dollar trend move in the second half of the year. All right, let's touch on crude oil here.
Well, the market's been down on rumors that Saudi Arabia wants to supersize the production hikes that are planned in the next couple of months, possibly increasing beyond what Dr. Anas Al-Haji and I discussed here on MacroVoices a couple of weeks ago. I don't see a directional trade here. On the term structure side, the term structure trade that I described last week is already performing quite well. So the term structure is evolving in the way that I expected it to.
Oil has been in an awful bear market. There's no denying this. And we've seen, obviously, some pretty ugly price action. The news is still generally negative, but almost all CTAs are short. There is a very large amount of bearish sentiment toward crude oil, but yet crude oil double bottom and is actually creating a very distinct basing formation. If we have any breakout to the upside, just driven by liquidity, there doesn't even have to be a fundamental macro reason behind it. The short squeeze on the upside could drive a $10 or a $12 advance off of the lows. And so while obviously the overall picture is pretty bearish, I do think that there's room for there to be lots of volatility, something that people are not expecting here right now. And let's see whether or not we start seeing some closing prices above the 50-day moving average and break above that kind of 63 to 65 zone that is a pretty significant overhead resistance, which could spur some short covering. Okay, moving on to page 5 here, we have the gold chart. Eric, let's start off with your thoughts here.
Well, Patrick, I got to hand it to you for last week's call. I was concerned that maybe gold was going to break down and get back down and retest below 3,200 again. You made the over call and said if we could get back above 3,300, we could quickly be back on track toward maybe a new all-time high. Seems like that's the path that we're on. I would say that the exuberance of gold, for a while it seemed like every dip was just being bought instantly. Unthinkingly, it was just every single dip was being bought. It seems like maybe now the market's a little more sluggish about buying every dip, but at the end of the day, after a fashion and a little bit of being on the fence, the market is still buying every dip in gold. So it feels like maybe this move is starting to lose a little bit of momentum, but it's still on. I'm keeping my fingers crossed. I love your 3,700 targets. Let's see if we can hit them.
When gold pulled back towards 3,200, it held the 50-day moving average, as we can see on the chart. It held the Fibonacci retracement zones and has now exceeded a lot of the short-term overhead resistance that would have seen failure points around 3,350. And so right now, obviously, we have not beat those April-May highs yet, but it is a primary bull trend, higher highs, higher lows, accumulation continuing to be evident. We have to give the bulls the benefit of the doubt that they're going to make this punch. If it does, like you were suggesting, the measured move is up towards the 36 to 3,700 level, very realistic upside target. But what's particularly interesting this time is we're starting to see broader participation in the entire precious metals market, including some very bullish price action in the gold miners. Page 6, I have the platinum chart. I did this on a weekly chart because I really wanted to highlight that there's been this kind of 3-year trade range for platinum. It's been just back and forth, false starts, big bouncing around this trade range. We have an attempt for platinum to break out of a 3-year trade range, and nobody is talking about it. Now, obviously, we have in 2022 and in 2023 rejected at this very level where it's trading. So we don't have a decisive bull breakout to all-time new highs or something, and it could reject, but you got to pay attention here, because if platinum here makes this breakout, we could be heading back to 2021 highs, and there being a pretty solid trade. On page 7, I have that silver chart. Silver was in almost a 2-month trade range between that 32.5 to 33.5 range. And here we had a breakout. Now, is it at a fresh new high? No. Again, very similar to platinum, we're approached all of last year's and this year's highs. But again, if silver was able to break out to an all-time high at the same time as gold, and platinum breaks this resistance, suddenly you have a broad precious metals rally going, and that's going to be hard to ignore. This is an area that's been trending, and our listeners should be watching all of these very, very closely. All right, Eric, I want to move on here, and let's touch on uranium.
Well, Patrick, we've just seen a huge, gigantic move up on uranium mining issues, leaving giant gaps well below the market on most of those charts. And as experienced traders know, those gaps are going to have to be dealt with sooner or later. So I say it's much better if we can tackle them now and set the stage for a healthy structural bull market. So my hope, and I have no reason to predict this, so it's not a prediction, it's just a hope, but my hope for this market is that we'll consolidate over the summer. Maybe some of the froth that we felt in the market will get shaken off, and we'll fill in those gaps on the charts by American Labor Day, 1st of September. That would be the back the leverage truck up moment in terms of opportunity, I think, in this coming uranium bull market, would be if we can get down to those gap fill points before Labor Day. In any event, I will be buying before Labor Day, whether we get down to those levels or not, in order to add to my already overweight positions. And then I think after the WNA conference, the World Nuclear Association conference in London in early September, is probably when the real rally is likely to really start. At least that's the basic outlook that I have. I'm crossing my fingers that we get some consolidation, maybe a little bit of correction between now and Labor Day to hopefully add to my positions at a lower price.
Finally, there's real positive macro headline news that is driving uranium. And what's interesting is that the uranium equities, like we talked about last week, are certainly the main benefactors of this. Now, we have not yet seen, obviously, the illiquid U308 spot prices moving yet. And obviously, it's illiquid, so there's going to inevitably be a shift. But when we look at the chart here of the Sprott Physical Uranium Trust, this has still not begun to react the way it should be if this is in fact a structural shift. And this is where I still think that there's asymmetry. While this you have to have a long enough time frame for this, but I do think that the downside risk of owning this here is very small. And at the same time, if for whatever reason this gets underway, then the upside potential is really good because it hasn't really started to participate on the upside the way uranium equities have. And so quietly, the Sprott Physical Uranium Trust is one of my favorite ways of playing the laggard that will catch up.
Patrick, let's hit that 10-year Treasury note chart in this week's deck. Walk us through it.
Well, I have that 10-year U.S. government Treasury yield chart up, and we've certainly been coming off that 460 high. We're now trading around 437, and we've seen generally that bond yields are taking a break. The key was that the 30-year tested its 2023 level, just over 5%. So we're seeing some pretty high bond yields. The big question, of course, is there going to be a breakout of yields to not all-time highs, but multi-year highs exceeding those 2023 highs? That is the puzzle to solve, because I think that if we saw that kind of a move is what could potentially be a market disruptor. I know Vincent was referencing that a little bit. Now, what is the probability you want to assign to that? I'm not sure I want to play the game of assigning a probability. Rather, it's about the observation that nobody right now seems to be overly worried about it. And it's one of those scenarios that suddenly, if we have an explosion in bond yields, we could have something that nobody cared about it until they all care about it all at once, and it could spur a market reaction. I'm not saying that I have a high confidence that will be the case, but it is certainly something I'm not going to be ignoring. It's going to be something I think needs to be continued to be watched carefully. And finally, I wanted to highlight the 2-10s yield curve on page 10. I went back all the way to 2000 because I wanted to show the previous two recessions and bear markets, both the 2000 to 2003 period as well as the 2007 to 2009 period, saw substantial steepening of the yield curve. Now we from a negative inversion, and so we have a scenario here where we have seen the steepening of this yield curve persistently over the last year to the point that we're now positive. But the big question is this accelerate? Will we see a scenario where this really rockets higher? Well, it's going to need two things. One, it needs a bull steepening, which is the Fed starts to at some point accelerate its rate cuts, and that could happen if something breaks in the system and the Fed is forced to be far more dovish than they're currently advertising, or it could come from the break in the long bonds, and that then let's say on the long end of the bond, like 10s and the 30s go ripping north of their 2023 highs. Are both of those scenarios possible? Absolutely. And I think that this is the puzzle to solve, is that is something like that going to spur a further steepening of this curve? Right now we are sitting again in a positive territory and a trend that's clearly been established over the past year. Let's see if it accelerates.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.